If the Fed dropped the rate twice this year, well, why aren't interest rates declining dramatically? Stay tuned and watch this video. What if I told you the Federal Reserve has cut interest rates 3 times this year, inflation has fallen from 9% to about 3%, and yet your mortgage rate is still sitting above 6%? It kind of feels backwards, right? Well, if you're thinking, man, shouldn't mortgage rates drop when the Fed cuts the rates? You're not alone, and a lot of people feel like they're being tricked right now. And honestly, the headlines don't help either, because they make it sound like rate cuts magically equal cheaper mortgages. They don't. I'm Scott Himelstein with the Scott Himelstein Group, your Los Angeles real estate agent. And if you want real-world housing information without hype or clickbait, make sure to hit and subscribe right now so you stay ahead of this market instead of getting blindsided by it. So today we're going deep. Why your mortgage rate is still high, and when they might actually come down, and what smart buyers and homeowners are doing right now so they don't miss opportunities, waiting for a day that might not actually come. So let's start with the basics. The Federal Reserve cuts short-term interest rates. That's called the federal funds rate. It's the rate banks charge each other for overnight loans. The key phrase, overnight money, very short term. So yes, when the Fed cuts rates, some things get cheaper fairly quickly. And this can include credit card interest, car loans, business credit lines, home equity lines of credit. Think of financial stuff you repay over months or a few years. But mortgages, that's a whole different story. You see, mortgages don't follow the Fed. Mortgages follow something else entirely. That's the 10-year U.S. Treasury bond, because a mortgage is long-term money. So when you lend someone hundreds of thousands of dollars for 30 years, you care about what happens over the next decade, not tomorrow morning. That's why, historically, mortgage rates sit about 2% above the 10-year Treasury yield. So if the 10-year Treasury yield sits around 4%, mortgage rates tend to land around 6%. And guess what? Lately, the 10-year has been bouncing right around that 4% zone, which is why we've been living in the 6% plus mortgage world. So if Treasuries explain the level of rates, what explains the stubbornness? And the answer? The spread. The difference between the Treasury yields and the mortgage rate, which normally runs about 1.5% to 2%, is currently closer to 3%. And that extra percent is money lenders are adding to protect themselves, and it's coming straight out of your wallet in the form of higher monthly payments. Now, I like to explain the spread the same way I explain restaurant pricing. You see, a restaurant buys raw ingredients at wholesale. They mark them up for you at retail, and that markup covers their rent, their kitchen equipment, insurance, employees, spoiled food, and profit, just to name a few. So mortgage lenders do the same thing. They borrow at the Treasury rates and then mark up the rate to cover the risk of lending to you money for decades. Now, normally that markup is reasonable. Right now it's beefed up, and that's a key reason mortgage rates kind of feel sticky and higher than what the headline inflation numbers would lead you to expect. So now let's break down why lenders are padding that spread. So reason number one, inflation has cooled, but not everywhere. You see, the headline number looks great, down from 9% to basically around 3%. But in the real economy, prices for essentials are still rising. Rent is climbing in most major cities. Home insurance is up, especially here in California, by double digits. Healthcare and childcare, right? So still outpacing wage growth. Well, not so much. So service labor is more expensive and staying that way. And lenders look at that and say, hey, inflation isn't gone. It's basically hiding under the hood. So reason number two, the Federal Reserve isn't buying mortgage-backed securities anymore. Remember, during the pandemic, the Fed stepped into the mortgage market and became the biggest buyer of mortgage bonds. Now, that pushed mortgage rates down because the biggest, most aggressive buyer in the world was saying yes to almost every loan. And now the Fed has stepped back and the training wheels are off, essentially. That's the best way I can put it. The private market is setting prices again, and private investors want higher yields to take the same risk. And higher required yield equals higher mortgage rates. All right, number 3, uncertainty markets, right? Uncertainty in the markets. The markets hate uncertainty more than anything else. And look around, we have geopolitical tensions overseas, political uncertainty at home, debates over the national debt, mixed economic signals, and a housing market that feels honestly really weird. Low supply, high prices, and buyers and sellers not totally aligned. And when the world feels uncertain, investors demand a bigger safety cushion. And that cushion pushes mortgage rates higher. Now, let's talk about the government shutdown for a second, because this always comes up. You see, during a shutdown, some investors rush to the safety of U.S. Treasuries. When demand rises for Treasuries, the yields fall a little. And when Treasury yields fall, the mortgage rates sometimes tick down just slightly, usually not by much, maybe 0.25% or so. So if rates are at 6.375, maybe you see a 6.125 for a moment. But here's the key. The shutdown dips are temporary. They aren't structural. They don't fix the bigger picture. In fact, Chris Whalen, one of the most respected mortgage financial analysts in the country, said recent mortgage rate declines weren't driven by the market at all. They were aggressive lenders competing to win business during slow volume periods. So that's for starters. And CoreLogic chief economist Dr. Selma Hepp notes that shutdowns can impact sentiment and delay key government data, but they don't change the economic forces setting mortgage rates. They're a blip, not a trend. So the real question is, when do rates really start dropping meaningfully? For mortgage rates to sustainably fall below 6%, 3 things need to happen. Number 1, inflation must cool across the full economy, not just in the headlines, just everywhere across the board. Number 2, the Federal Reserve needs to signal long-term support and stability in the mortgage market. And number 3, and I think most importantly, investors need to feel confident again instead of being defensive and cautious. Right now, we don't have all 3. And until we do, the mortgage rates are going to be volatile and sticky. Most forecasts, and I mean the realistic ones, don't expect mortgage rates that stay under 6% until 2026. So not today, not tomorrow, not the next quarter, not basically until next summer. We don't know. And it's definitely not 3% again. 3% mortgage rates, that was an anomaly created by a global crisis and unprecedented. So you're not going to see that again. So like $1.20 gasoline in the 90s, amazing while it lasted, but not the new normal. So what does this mean for you if you want to buy a home or refinance? It means don't sit on the sidelines waiting for a once-in-a-generation rate to just magically return. Make decisions based on the market we live on right now, not the market we remember. So if you're buying, these are strategies right now that you need to keep in mind. Adjust your budget, explore surrounding neighborhoods, look at new construction communities that are offering a lot of incentives and rate buy downs. Ask right now the seller for credits and plan for a refinance if rates come down another half or point over time once you've moved in. If you're refinancing right now, don't chase perfection. A half a point improvement may make sense. You don't need the bottom to win. So time in the market always beats trying to time the market perfectly, right? And here's the real takeaway for me. The perfect house at a slightly higher interest rate usually beats the wrong house at the perfect rate. People build wealth in real estate by owning property and letting time work, not by waiting forever for the perfect moment. So if this helped you out and this helped you understand what's really going on, Basically, I want you to hit the like button so more people can get clear information instead of confusion. Subscribe if you haven't already, it means a lot. And if you're thinking about buying or selling here in the greater Los Angeles area and want a custom game plan that fits today's market, reach out to me. I'd be honored and love to help you navigate it. I'm Scott Himelstein with the Scott Himelstein Group, and thank you so much for watching this video, and I'll see you on the next one.